Awesome. We're going to get this party started. So thanks for everybody being here tonight. So first thing we're going to do is this is going to be a very interactive session. So I just want everybody to give themselves a round of applause for being here tonight.
There we go.
So that's the best part of tonight. At least we gave you that, right? So I'm Kurt Rathmann. I'm a CPA. I'm the CEO of ScaleFactor.
Andrew Millet. I'm also a CPA. I am the Director of Solutions at ScaleFactor.
I'm Mike Bryant. I'm not a CPA, but I'm the Growth Manager at ScaleFactor.
So, when Team Austin kind of approached us about speaking tonight, we've got a lot of things we could talk about. And we went through, did we talk about taxes? And we thought that maybe we would have a couple people there. We thought about, do we talk about our journey? And I know a lot of people do that. But this is the first and last time we'll mention ScaleFactor. The reason I say this is to hopefully earn us a little bit of credibility up here tonight. We have seen hundreds of companies go through the process of scaling and starting and finishing. We've seen companies that are wildly successful. We've seen companies that are mildly successful. We've seen companies completely fail. So when we were thinking about what we're going to do, we put our heads together and we came up with the top 10 questions that business owners should ask, but typically don't. So with that, Andrew's going to do a little gauge of the audience here, to kind of so we can cater our presentation to you guys, and we'll go through this. So one thing I encourage you guys is this is really meant to be interactive. So we'll have question stops along the way, and Mike will explain this, but please ask questions throughout. There's no other reason that we're here. Okay.
Walk-up song?
It's a walk-up song. That was not prepared. So we do want to get a little bit of an idea of who's in the crowd today. So out of the crowd today, who here either works for a startup or has worked for a startup before? Okay, so we're at the right place, guys.
Yeah.
Who here has actually started or is a founder in a startup? Okay, right on. What about maybe you're thinking about starting a business and you haven't? Okay, right on. So, who's here for the free beer? Yeah. Okay, cool. So we know that anytime you prepare for one of these types of things, you're gonna have a wide varying audience. We tried to prepare this as much as we could for all three of those segments, but mostly we're preparing this for people who are starting a business or have just started a business, thinking about starting a business. That being said, we want to make sure that we cover it all. So Mike's going to tell you a little bit about how we're going to do that and how we're going to break this up in our presentation.
Awesome. Yeah, so we prepared a list of questions, as Kurt and Andrew have alluded to. We'll have periodic breaks after every string of 3 to 4 questions that we want to get everyone's input on, and really it's opening up the floor to see any questions that you all may have. So I encourage you guys to ask questions at those times. And then at the end, we'll have kind of the rest of the time remaining for any other questions. We just ask that any questions that you do have, just being cognizant of everyone else here in the room, let's try to make sure that they would benefit everyone else. The answer would benefit everyone else. If you have something very specific to you or your business, maybe something a little more complex, we'll definitely all be here after to answer privately if that's necessary. So without further ado, let's get going. So. First one we've prepared here is what sorts of documents should I have to start my business?
So this is a broad-ranging question, and we're gonna try to hone in on a couple things that we typically see businesses that are starting out that they need to focus on. So we're gonna skip over. I set my business up. We're gonna skip over. I went and registered my EIN with the IRS. I got my company set up with the state. So what's the next step? This really depends on what kind of company you're setting up. But it really comes down to the company operating agreement. So any of those people that said they set up an entity, who here is like a C Corp or they got recommended to do a Delaware C? Okay, so you went through the full process of setting up the articles of incorporation. It was all formalized. It's all pretty straightforward. Did anybody here who said they started a business set up an LLC? Yeah. So LLCs are pretty popular. The reason they're popular is because they're pretty easy to set up. They're very flexible, and so usually when you go and say, I'm going to start a business, the LLC is what people say to do. It's important that everybody, when they do that, sets up what they call an operating agreement. What is that? So it's really what is going to run your business or how you are going to run that business. And so you might be going and thinking about starting a business with some friends or your buddies or whatever, and you say, well, I don't need that. Like, we'll all figure it out as we go. Not a good way to go. So when we talk about the first document that you need to have in place, if you're setting up that LLC, you need to make sure you have an operating agreement in place. The operating agreement is going to drive everything from who owns what, and it's literally a physical document that says who put what into the business and who owns what, how income, loss, distributions are going to be allocated when the company starts to grow. It also talks about who manages the business and who can make decisions in the business. If you want to go and add a partner or you're going to remove someone from the business, how is that going to get done? So making sure that you have those things in place is super important as you go and start your business. So now you've started your business. Kurt, what are some documents you might need as you get going?
Yeah, so I'm going to take this to an example I have. So who in here has ever bought or sold a private airplane? Anybody? I have not, so I'm going to put my hand back down for a second. But when you do buy or sell a private airplane, or an airplane in general, there's something that is really valuable in that airplane, and it's the logbooks of the actual aircraft. So you can have this beautiful aircraft, and all of a sudden you don't have the logbooks, and it's basically worth half the value. So your company's literally the same way. There's four main things. So if you're taking notes, there's four main things that you need to make sure that you have that are equivalent to the logbooks of that airplane or of your company. It's a proprietary information agreement for everybody that works for your business, whether it's an employee or a contractor. This is basically assigning all the IP rights of everything that you guys do to the company, not to an individual. The second thing is a confidentiality agreement. Everybody does a lot of things with NDAs and things like that today, and I think a lot of that's to feel important as you go back and forth. People have varying opinions on that, but this could be a literal paragraph in your employment or contractor agreement that really solidifies the confidentiality. The second thing is a non-compete. So you're protecting here if you've got a startup that all of a sudden you're 5 people and something happens and somebody goes rogue and all of a sudden they're going to start another company that's going to compete directly against you. This is going to stop that from happening. Now, if that were to happen, you've probably got some cultural issues and other things that are happening in the business, but legally you need to protect yourself against this. And the fourth thing is a non-solicitation agreement. So this basically, if that were to happen, somebody leaves the business and goes and starts a competing company, the worst thing you can have happen is they start recruiting your people to go work for them, right? So non-solicitation agreement basically says that you cannot do this. Now, we're not attorneys or anything like that. That's kind of a disclaimer here. But those four things, a proprietary information agreement, a confidentiality agreement, a non-compete, and a non-solicitation agreement are your logbook of your company. And why this matters is this. If you're ever to sell your business or get acquired, this is what's going to be asked. And so if you don't have this, what's going to happen is you're rushing around to everybody that's ever done anything for your company and trying to get them to sign this. That's a pretty hard spot to be in. So with that, we're going to move on here, and I dropped my, oh, here we go. So my next question for Mike here is, you know, how should I have my banking set up?
Awesome. So the easy answer is you should have it set up. A lot of times the first mistake people make is using their personal account to use for their business. It's just very, very hard. You spend all that time forming your LLC, and you have these formation docs and all these operating agreements that we're all talking about up here. And then, you know, it's the whole point of the LLC, limited liability corporation, is limiting your liability. Well, if you're using a personal account, it's very hard to distinguish your business from your personal. So if you ever to get into a tough situation, it's just a lot more difficult to really prove, you know, what was business, what was personal, and you could be incurring like personal debts for things if you ever got in a tight spot. Next reason is just simplicity. Everyone wants to celebrate their wins, and you know, sometimes you kind of have to cry over your losses, but you're looking at one place for seeing what your finances look like for your business. It's much easier to do if you just have separate accounts. And then third reason is just the cost. You're going to have to file a tax return if you are a business, and how you file a tax return is creating a set of books. You create a set of books based on the accounts that you have. If you're doing it yourself, you're going to spend a lot of time at the end of the year going through your own personal bank statements and being like, this one was a business expense, this one was personal, or you're going to pay someone a lot of money to do it for you. So those are kind of the top 3 reasons why we should have a bank account. Moving on here. Next piece, how should I pay myself day to day, and how should I pay my employees? Andrew?
So everyone wants to know how they're going to get paid, right? You go and start this business, you're putting all this work into it. How you pay yourself is something that we run into all the time. And I'm going to focus first on owners. So we really break this up between owners and non-owners. And when I say owners of a business, I mean any owner of the business, whether it's 0.0001% or all the way to you own the whole thing. So as we break that group up and we say you're an owner of this business, how do I pay myself? The next question is, what entity type are you? So we talked about some of those C Corps that were out there, some of those LLCs that are out there. When you're a C Corp or an S Corp, it's pretty straightforward. So you're an owner of your business, but you're also an employee. So when you go and want to pay yourself, you actually need to be a part of the payroll of your company. So that means you're getting a W-2 at the end of the year, you are subject to withholding requirements, everything else that's normal for an employee-employer relationship. So think of yourself as kind of like wearing two hats. The other one, which is a little bit more what we want to focus on, is when you're a partnership or an LLC. So what we see way too often is people come to us, they're an LLC, they're a partnership, and they say, hey, I can pay myself, I was told that I don't have to do any withholding, I can get myself a check here, I can make this bank transfer over here, and it's all fine. I was told it was all fine. And yeah, that's true. But the IRS is always going to get the taxes somehow, some way, and even though you're not subject to those withholding requirements of an employee, they will get it when you go and file your income tax return at the end of the year. So if you're one of those people that just started an LLC, or maybe you've been running an LLC, you're thinking about setting up an LLC, it's really important to focus on what taxes you're going to owe for what you're paying yourself and making sure you're prepared for that. Don't be the guy or the girl who is sitting next April with that big tax bill and unprepared. So that's the really big thing that we like to focus on when we talk about how do you pay yourself as an employer and how you pay yourself as an owner. How do you pay your employees, Mike?
Yeah, so all the non-owners, there's really two ways. You're either paid as a W-2 employee or as a contractor who gets a 1099. And a lot of people think, well, the cheapest option is to do the 1099 route. The business does not incur any additional taxes outside of what it's paying to that individual. But it's not just as simple as a financial obligation. It really comes down to the relationship that the person has to your business. There's a form, no one's going to fill it out, that you can send to the IRS that will make a formal ruling as to if the person is an employee or a contractor. The takeaway from the form, there's kind of four things. Do you set the person's hours? Do they provide their own tools to perform their job? Do you give them clear direction? Are they free to work for the general public? You can kind of go down and really ask yourself, well, if you're setting that person's hours, they kind of come to work and you give them a computer, they have a desk, a chair, well, they're an employee. Even though it's cheaper to pay them as a contractor, longer term, it might bite you in the butt later when they find out that they didn't get a W-2. So, big difference here. When you pay someone as an employee, they get a W-2. It's always the more conservative route. You will incur extra costs as the business, but there's the risk always paying someone as a contractor, although it is cheaper, that the person may be considered an employee and they can always come back later and have the IRS do something on the next year. So next question we have here.
Mike,
Yep.
so could you talk about how it affected Uber?
So can we hold that? We have one more and then we'll stop for questions.
That's a good one, though.
That's a good
That's
one.
the first question we'll answer.
Yeah.
So the next prepared question we have here is, what expectations do the federal and local governments have for me? Andrew?
Well, that question's so good and such a surprise.
Well, hopefully you're not prepared then.
Yeah, so we talked about a lot of different things that both the federal and state government can apply to you. We talked about payroll taxes, we talked about getting registered with the state, we talked about getting an EIN. What we wanted to do is highlight a couple other things that people don't normally think about. One of them is the types of taxes that states can put on you. So how many people here maybe moved to Texas or know that Texas is a non-income tax state? Okay, so a good bit, right? And as an individual, it's right on. You do not pay personal income taxes in the state of Texas. So I'm sure some of you guys are from California. You're like, that's why I came here. Yeah, you hear it in the news. You hear about sportscaster or your sports athletes coming here to save on taxes, right? Well, for your business, you might say, okay, so I'm here. There's no income tax in the state of Texas. But don't be fooled. There is this thing called the franchise tax. And although it's not based on your income, it is based on the revenues that you make. And so it's very closely the same thing. So the reason we're bringing this up is that when you're working in a state, you need to make sure you know what types of taxes that they're going to go after, because that can come back and bite you when you're going and making your plan of what your expenses are. The other one we want to talk about is sales tax. Sales tax, in a general sense, and what most people think of is that little line when they go to the store and it says, "Here's my sales tax," and I pay it, no big deal. If you guys are in CPG, you work in sort of manufacturing.
Andrew, what is CPG? Just to make sure.
Yeah, so this is consumer packaged goods. So if you work in a space where you sell inventory and you're selling things, you understand sales tax. You buy a good, you collect sales tax. But as many of you guys might know, maybe not as well as us because you don't follow tax legislation or any news like that, but the state governments are not doing well right now. And so what they're basically trying to do is find any and every way they can to collect tax. So what they're doing is they're expanding how do we collect tax. So some of those ways is they're starting to tax things like services. So now I provide a service. I got to collect sales tax? Yeah, some states you do. Maybe I rent equipment. I'm not even making a sale. You might have to use tax. You got it. The other thing that they're doing is they're creating new rules for how they can tax you or how you fall into that. So a lot of you guys might think or consider using Amazon fulfillment services if you're in the CPG space. And what Amazon does is they will actually hold and sell your inventory and create that basically that fulfillment part of the process as you're growing and you're not ready to really take that on yourself. Well, if Amazon's holding inventory in certain states, you could be subject to sales tax. So why is that important? Well, maybe you didn't know that, and so you don't go register and you don't go file for sales tax and you don't collect that from your customers. So then you're stuck in really a situation where you have two options. One option is you go back to your customers and you say, "Hey guys, remember that stuff that I sold you 2.5 years ago? Can you pay me like 7% because the state's asking for it?" Good luck, right? Like that's not going to happen. So more often than not, you're stuck in situation number 2, which is you're going to incur that cost. So this is going to be an unforeseen cost that could really throw off some things. So it's definitely something that we always like to cover. And the moral here is just making sure that as you enter new states, whether it's adding employees, whether it's adding inventory or they're holding stuff in that state, or even states that you're transacting in and doing certain activities, you want to make sure you know what rules and what taxes you might be held to. All right. We got through the 4 compliance questions. Those are the roughest ones, and I know we said we weren't going to talk the whole time about taxes, so you made it. We are going to stop for a second. The first question was over here. So we're going to stop for 5 minutes and take questions. Uber, and why Uber is, can you restate your question?
So can you talk about how Uber has affected this and how businesses are dealing
In the terms of?
Contract.
1099 versus W2?
Yeah.
Yeah, so I wouldn't say necessarily Uber has affected it. It's more like they're getting, you're seeing a large kind of legislation come down to Uber where, that may be the precedent now for other, similar companies that are providing that kind of business model where people are just kind of actively looking at a marketplace, being attached to a consumer, and then there is a purchase there that happens where the person driving isn't really getting clear direction. I mean, now I'm getting kind of personal with it, but the person driving isn't really getting clear direction. If you think about like the FLS, Fair Labor Standards Act, that kind of dictates even further if someone's an employee, are they salary, are they hourly? It's like if you think about the Uber driver model, it's like, well, just because someone's like on the clock doesn't mean they could be actively driving a customer around. So it's like, should I be paying that person for work that they're not really doing? They're like on call. So if you think about it like that, it's like, well, no. Is Uber providing any tools for that person to perform their job? I mean, the app to connect them to other people, but services are offered to the general public. They can stop working whenever they want. They don't have their own hours set. So,
well, and how many Uber drivers do you talk to that are connected to Lyft, Ride, Fasten? So drawing the line of whether you're an employee or whether you're a contractor is pretty tough, and the facts point more towards probably contractor. You could be just working for Uber, so maybe that rule is a little bit different for you. But yeah, it's tough.
one thing here to just to note is that this is a fluid kind of environment, right? So either with Amazon, affecting all of our lives and the way we consume goods, or Uber as well, or any on-demand type service, is that states are normally used to getting a certain amount of revenue from the general population that's transacting in that state. As the world starts to change, that's being affected, right? So it's reasonable to expect the state to also change. And I think that's one of the key takeaways that we want to have here tonight, as far as the tax and sales and use tax, is that this is a fluid environment. One year it's going to be one way, and the next year it could easily be the second way. So this is not a set it and forget it type environment. It's definitely something you've got to keep track of as you keep going. In the back.
The first couple bullets seem highly litigious. Who and when do you involve experts as far as drafting your documents and how does that proceed?
Yeah, so we're not attorneys, but we're of the opinion that you should always be working with an attorney. And there's varying levels of attorneys all throughout, right? But one of the things that we see quite a bit is that we see friends start companies all the time, right? And they're best friends, maybe they're roommates in college, kind of go down the list, right? And this is the takeaway that we want you to have, is that even though you could be the best of friends, maybe you grew up in 6th grade and now you're all the way through and you know each other and whatnot, and it can be really easy to have a handshake agreement and say, hey, we're going to start this business and we're going to do this. Our experienced advice is to not do that. Even the best of friends should have agreements. And one of the key takeaways here is that think about it, right? When are you looking at those agreements? It's not when everything is going well, right? No one pulls out all their documents and everything like that when you just completed this massive milestone that everybody's been working for, right? You look at agreements when things are going bad. So even though you're best friends or you've got relationships with people, it's one of the key things is to keep in mind that agreements are for the bad times, not necessarily the good times. So keeping that in mind when you're drafting them.
We'll do one more question.
Sure. On limiting liability with bank accounts versus personal account, if you already have your LLC created and you are using bank account, what about for something like paying for ad spend? Does it matter if you're paying both from a business account and a personal account other than bookkeeping? Or is there a liability issue?
Yeah, so that's a good question. We generally recommend always to keep business with business and personal with personal. It's not to say that if it push come to shove, you couldn't somehow argue that what you were spending out of your personal was related to the business. It's just much easier to argue when all of it was in one place. There is the bookkeeping side and all of that, right? You go file your tax return and now you're looking at 2 bank accounts and doing so. Administratively, it's tougher. But again, we're not lawyers, but it is definitely something that has been contested before, and it's up to you to kind of prove whether that was a business expense or not. Generally, having it in that business account is going to give you extra sort of support as to what the expenses of the business were versus your own.
I'm gonna just piggyback off that for a second. It's our message here is more about the practical nature of it. So when you start commingling funds between your business and personal life, whether your business is doing well, Mike's point was you tend to celebrate, right? You might go out to a wonderful dinner with your team, right? But on the other side, when your business is not doing well, you start really getting in a headspace where you're worrying about the hierarchy of needs that you have as just a person. And that's where we see a lot of people get in trouble. So if you start commingling your business with your personal, it's very hard to start separating that. And we encourage everybody to keep that separate for that reason. There are times where things aren't going to go well, right? There's people in this room who will start something great, but for some reason, whether it be timing, yourself, investors, whatever it might be, that it's not going well. We recommend, we've seen people in the depths of despair of failure, that keeping it separate is the better thing to do at that moment. When you start throwing in life savings and the property and everything like that, that's really when, after the fact, when the dust settles, you kind of wish I wish somebody would have told me not to do that. And so that's our main message.
All right, we got to shut the questions off now until the next. We're going to have questions again, a second pause, and at the very end we'll open it up for any other remaining questions. But now that we've kind of gone over all the boring stuff, we're moving on to fundraising. Woo! Everyone loves money, right? So next piece, how should I go about fundraising, Kurt?
Yeah, so I know a lot of people talk about fundraising probably here, and so I'm gonna, I broke it down into to really 7 key things that I wish everybody to take away. The first is to be completely obsessed with your idea. A lot of the times at the seed stage or at the startup stage, an investor is not necessarily investing in the company. They're investing in you. And so if you're not completely obsessed where you're here on a Wednesday night or up at night really thinking about your idea, that's noticeable in your conversations. The second thing is just get ready to hear no. And you've probably heard this before, but this is very, very real. You're likely to hear no way, way, way more than you hear yes. You only need a couple yeses. So after you hear a couple yeses, you'll probably stop fundraising. And just by the nature of fundraising, that's how it works. The third thing here is to network and network and network. Fundraising is a chance to expand your network, right? You've got something exciting to talk about. You've got your idea that you're sharing with people. You're getting a lot of feedback. And so if you're not an outgoing person, maybe you find somebody that is, that can help you fundraise or help you kind of get over that hump. But you definitely have to have the ability and the desire to go and completely network and put yourself in situations that you're not comfortable with. The fourth one here is to get help from people that have done it before. This is one of our main takeaways, right? So we see a lot of entrepreneurs that are trying to fundraise in the silo that they're in, and they're not necessarily referencing a lot of people that have done it before and done it successfully. And so my key takeaway with that one is don't reinvent the wheel. There's a lot of people that have done this before. Find a mentor, find somebody that's done it before, and allow them to guide you through the process so you can find your own way. The next thing here is, it's kind of segueing into the next part of the talk, is just determine how much money you need. So fundraising, we see all variations of this, right? We see people come to us that are thinking they need a lot less money than they actually need, and we see people that want $10 million, right? And you ask, well, what are you going to do with the $10 million? And it's kind of like, well, I don't know, but that sounds like a good number, right? And so when you go into that, the key to fundraising is milestones. You've got to really break down milestones in your business and understand what it's going to take to allow you to get to that next milestone. One of the biggest mistakes is if you over-raise and you raise too much money, you may have just diluted a lot of your ownership, and you may have not needed to do that. So milestones are key, and so that kind of goes into the last part of this, is just knowing your financial whereabouts as you go through the fundraising process. And so you've got to really determine, and the only way to do that is through a great forecast or a great budgeting model, which will segue to that right now. So Mike, my question there is, why should my business have a budget?
Awesome. Yeah, so starting out, I think it's important just to define the difference between a budget and a forecast. So when you go out to fundraise, that's really what the forecast is used for. It's a longer term projection, usually 3 to 5 years. There's a visual output, so think like the pretty graph that goes up and to the right showing how you give me this money and I'm just going to make you so much more. A budget is a lot shorter term. It's a little more detailed. They're usually 12 to 24 months. It just provides a lot more, like operationally, how we're going to do things in each month. So 3 reasons why you should have a budget. The first is it holds everyone accountable. Starting out, you're going to take on cash from an investor. If you don't know what you're going to do with that cash, it's very easy to spend it up quick and not really even know where it went. So, having the budget to hold yourself accountable, it just kind of gets everyone on the same page. Each month you're updating with what actually happened. You can see variance. It provides a collaborative discussion with your team as to why the variance occurred. You can always change the budget, but just having one in the first place is just always a good thing to start with. Second, we talked about cash burning quick. If you don't have the ability to kind of see where the money is going, it's very difficult to know if it's going to the right places. Final topic here, or final reason why you should have a budget, seeing into the future. So a lot of times cash runway is one of the biggest things with the startup. How much longer do I have to survive? 3 months, 6 months, what have you. Having a budget really provides the ability to ideally foresee and make changes before things get in that dire straits where you're having to cut people from your team. No one wants to have those conversations when you've had people very invested in your company and things really aren't working out. Ideally, if you're budgeting correctly and updating it, you can kind of see these things before they occur, make the right changes, and then put yourself in a better position to move forward. So, key performance indicators, or KPIs. Why should I have these, and what make them drive my business, Andrew?
Yeah. So I got my own mic.
Oh, good. Well,
I don't need that.
Yeah.
We're going to be crossing all over here. So who here today uses KPIs in their business? Okay. Who here knows what a KPI is? More of you. Great. My next question would be, why aren't you using them? So what is a KPI? KPI is a key performance indicator. What is that? So a KPI is a tool that most people use when they're using it successfully to drive performance towards your company's goals and objectives. So think of it as like the metric aspect of that. So you go out, you fundraise, you've now got all these things that you're planning to do. You have to go out and set, what are my goals and objectives of the business? Or maybe even more detailed than that. What are the goals and objectives of this department or this person? Well, the KPI is the metric that tracks that performance. So that kind of leads to what should I do when I go set that KPI up? Well, the number one thing you want to do when you're setting a KPI is it has to be aligned with those goals and objectives. So let me give you an example. So let's say you've gone out, you're looking at the quarter, and you say the most important thing for our business this quarter is customer happiness. And we want to make sure that all of our customers are super happy. We've got the happiest customers in the world, right? That's our goal. That's what the investors are asking for, everything else. So you go and you say, what are we going to track for our sales team? Well, our sales team, we're going to track total revenue. That's our KPI. Well, you're going to get to the end of the quarter, and you're going to have maybe a lot of sales, because you were tracking to how much sales can we get, and that was literally the only thing that you were tracking to. Well, we all know, at least if you've been in a startup before, that more customers doesn't always equal happy customers. And quickly you may find that you didn't meet that goal or objective that you were setting out to do. So alignment of your KPIs and making sure that what you're measuring is aligned with your goals and your objectives is totally crucial, because it can go the wrong way. Speaking more about like what KPIs are and what they're useful for, there's really two other things that we like to normally tell people what's the importance of a KPI and why would you use it. And so one's more outward focusing and one's more inward. On the outward side, let's say you went through the fundraising process, and now your investors are saying like, okay, like what have you guys been doing? A KPI is a great way to show that. So you're going to have investors that do want to see it all. They want to dig in. They want to see your income statement. They want to see your balance sheet. They want to see every single thing that you've done. But more likely than not, they just want to see that you can set a goal and objective, figure out how to measure against that, and then prove that you have made considerable performance in enhancing your business towards that objective. And a KPI is a great, simple way to do that. On the internal side, it comes down to just internal management and how you manage your people. So we know, and we've seen it time and time again, as you work with startups, everybody wants to do everything, and everyone's all over the place. And it's kind of like, how do I organize this group? What we commonly see is the two limitators are focus and time. So a KPI is a great way to help solve this. If you can set up a key performance indicator or a metric that you're trying to gauge that department or that individual on, it makes the decision process that they go through day in and day out much more simple. It goes, if I make this decision, will it lead towards that indicator and show performance and show that I'm leading towards what I wanted to do for that key objective? If the answer is yes, I do it. If the answer is no, I don't. It makes a much simpler process for your company, especially when you're in those early stages and you're just trying to show that you can do something. And so it's something great to establish. So that's what we have on KPIs. We're going to take another break here to go over questions on this this segment. So what do we got?
Brand new startup, been in business maybe 6 weeks. How do I even think about budgeting? Especially like, I don't know how much money I'm going to make. I don't know what I'm going to spend it on. How do I think about budgeting for 12 months?
I can take that. Yeah, so I think the best thing to do in that situation is to put out some plan. Whether it be wrong or right, to project some sort of expectation upon yourself and your performance, and then to measure against that plan. going through that process is you're going to prove yourself right, you're going to prove yourself wrong, and probably do it back and forth 20 or so times.
There's no such thing as a perfect budget.
Yeah. Has anybody ever read Venture Deals, Brad Feld's book? So one of the quotes in there is that every projection out there is what? It's wrong. Right? And so that it's more of the discipline of putting out an expectation and then being able to measure against it and understand why your variance happened. So if anybody's starting out, it's just the beginning of that discipline that you're developing, and that will pay dividends down the road. Anybody else?
We went up here.
So, for the fundraising, I was told we are LLC, and how complete or time consuming and costly is to convert, how it will help to convert from LLC to C, that way you can have a class of shares, or right now we are LLC partnership.
Yeah. Great question. This is a common question. Does anybody know, I'm going to use an example here. Does anybody know that a cow knows only how to walk upstairs, but they don't know how to walk downstairs?
Senior Bryant,
Right? So going from your LLC to a C Corp is much the same way. So that's my other vivid image I wish you guys to take away here. So if you convert from an LLC to a C Corp, great. You can do that all day. It's a very, most states have a statutory process to do that. It's pretty inexpensive to do that. It's the timing of that is what matters. And more so the effect of once you're a C Corp, if you ever wish to desire to go back to an LLC, that's the much more costly process at that point. And so most states, Texas in general, has a very statutory merger process to go through to become a C Corp. And it's a pretty inexpensive process. You should not be charged a lot for that.
And doesn't matter when you do it, we have calendar year as a fiscal year. Does it matter when you do it?
Yeah, so.
It depends.
Yeah.
So it's one of those things that you have to look at for your business. There's advantages to being an LLC, there's advantages to being a C Corp, and the time of year and what activity you've had in both of those periods or you expect to have in the period after that can determine that. So without knowing, your specific situation, the easy answer is it depends. But happy to follow up and hear a little bit more about your question.
I'll say something practically there. So we recommend to not convert to any different entity type in the middle of the month. You're generating a lot of accounting fees and a lot of different it's very complex if you're going to convert on the 17th of the month. So if you're going to convert to a different entity type, we recommend on the end of the month, or the easiest is sometimes is the end of your fiscal year. But definitely the end of the month is going to save you a lot of money. Cool. So with that, I'll segue to the next part. Mike, do I need to do accounting on a consistent basis?
No, it's Andrew.
Andrew, I don't know.
That's me.
Do you, Andrew?
He doesn't know, yeah.
So he's asking an accountant if he needs to do accounting on a consistent basis. We know the answer. It's yes. I like to reformat because the way that we normally get this question is not that. It's you're telling me to do all this accounting. I really only need it for my tax return. Why don't I just wait? I'll just wait to the end of the year. I'll meet up with the bookkeeper. They'll take care of it. I'll file my tax return. That's the more common way that we get this question. And the way we always approach this is, practically, yeah, that can work. If your business is really not trying to do any of these other things that we've talked about today, you can just wait. But a lot of those things that we did talk about today, making sure that you're compliant and you understand what's going on in your business, tracking your actuals to a budget, or maybe you have some KPIs which are financially driven. If you don't have accurate and up-to-date financials, all those things are basically worthless. So having that accounting up to date is important for those reasons. Beyond that, who here has actually been through the fundraising process or even asked a bank for a loan? So you go out, you ask for money. What do they ask for? Financials, right? They always want to know what's going on. So having those financials up to date is something that may not always be required. You talked earlier about equity and maybe being able to raise just because you're a great CEO and you're passionate about your business, and sometimes that works. But the financials are always a good thing to have in place. I like to talk about an example here because we always get this example. Let's say your business is doing well. You're booming. You've got that big customer deal you were looking for. And they just ordered 10x what you planned to do for this month. And you say, we don't have what we need to prepare for this, right? How am I going to do this? Well, you go to the bank. And you go to everyone that might be able to lend you money. And you say, give me money. I've got this great deal. You're going to get your interest. Give me whatever interest rate. I don't care. Give me your financials. So now you're saying, okay, let me run around now to every single accountant in town that can get my financials up to date right now and accurately. What you're gonna get into there is one, a timing issue. Just can those accountants provide you what you need in that short time frame where you need that cash to get going? What you're also gonna run into is price. You basically just lost all your leverage in what your pricing needs to be, because now it's, hey, I need this right now, and they're going to say, okay, well, this is what it costs. But more importantly than the price or the timing, I think the thing to note here is that when you're in that situation with your business where you are ready to go and expand or get this big customer deal, what should you be focused on? You should be focused on that deal. You should be focused on making sure your customer's happy, making sure that run gets done. That's what you ultimately need to be worried about. And when you're worried about getting your financials in place so that you can get that loan, that's not where you want to be. And we see it more often than we'd like to admit, and it's something you definitely want to be prepared for. So is it still needed for your tax return? Yeah. So why not get kind of ahead of it is normally the way we approach it. I know we're accountants and that sounds like that's where it's coming from, but it really comes from a state of understanding kind of what startups go through and where they need to be. So now we've talked about why you need accounting on a consistent basis. I got a question for Mike here, or no, for Kurt.
Yeah.
We know accounting is not, I just talked about it, it's not what entrepreneurs want to do. It's not what anyone in this room, who here actually likes doing accounting? Woo! We got one. Right on. We should have all raised our hands. Sorry to make everyone look at you. Yeah, so what we're going to do now is talk a little bit about things you can do in your business, why it's important to get to the cloud, and really ways to kind of enhance your accounting environment and do it in a better way. So Kurt.
Yeah, so as we talk about the cloud, one of the things here is it's the middle of 2017. So my biggest reason to move to a cloud environment is simply because it's the middle of 2017 and it's time. The second reason, though, and kind of coupled together, is that traditionally the way this space was curated as we've gotten here is QuickBooks Desktop or something like that, right? So you've got an accounting file. One of the things we hate to see is it's on a laptop that's got a single hard drive that can go corrupt at any moment, right? So why would you put your entire company on a single computer that all of a sudden it could vanish? That's one of the biggest reasons. But secondly is more operationally, right? So everybody's holding a device. If you're not holding it right now, you've got it on your belt or in your pocket or whatnot. And just the ease of access to information. What we see startups today is you have a couple people here in Austin, you've got a couple developers maybe in Boulder, you've got somebody in some other state that you're working with, and we see that the desktop type accounting environment or information flow is a great, wonderful way to create data silos in your business. One of the big inhibitors to growth that we always see is just the availability of information. As you continue to grow and make decisions and collaborate and things like that. So anything on the cloud, as you guys know, all you need is an internet connection or a cellular signal to get through. Secondly, though, is just this app ecosystem that's been created. And you guys have all felt this as we've gone, but the idea that all of a sudden you can have Expensify connect to your accounting file and there's efficiencies gained there, that's just the beginning. So at the startup and seed stage, we recommend QuickBooks Online or Xero as great softwares to house your accounting file. As you continue to grow, there's NetSuite and Intact and Dynamics and things like that that'll definitely house you as you get to a larger stage in your company. But still, this is all in the cloud, right? So you're not having to worry about something on a laptop. You're not having to worry about taking a sliver out of this accounting file and passing it to your tax accountant at the end of the year, and you can't manipulate that at all. Who's ever done that before? Is anybody? No? Okay, so we see that at times, right? Your accountant takes part of this file, and now all of a sudden you can't even understand what's going on there. So with that, I'll pass this to Mike to kind of bring us home as you're growing. So Mike, what's the progression of my financial department as my business grows?
Yeah, so it really depends on the stage that you're at. Being realistic, starting out, if you are just turning your idea into a business, welcome to the show. Welcome to entrepreneurship. You should be doing a lot of this yourself. And that's kind of what you signed up for. Maybe with a little bit of professional guidance to set things up. Maybe check in monthly or quarterly, but a lot of this you should really be doing yourself. Second stage is kind of early growth. You're starting to generate some revenue. At that point, when you're now focusing on these customers that are giving you money and you want to keep them happy, it's really the time to start outsourcing a lot of this work. You don't yet have the need where you need a full-time person within your business providing that type of service, but at the same time, you don't need to be spending your time doing it either. So there's a lot of good outsourced solutions there when you're in kind of that early growth revenue generation stage. Third is when you're an established business. At this point, it really depends on the business model. We've seen a lot of people able to continue using outsourced providers through expansive and massive growth. What tends to happen though is you'll need some people full-time within your business that are focused on kind of the finance or finance ops that are kind of working with the customer relationship, and then they may work alongside an outsourced provider who's very specialized that person's skill set doesn't really cover. Overall, finding a solution after you started generating revenue is necessary, and it should not be the business owner or the CEO doing this after a certain point. So last part now, questions, anything that you came here for that we did not cover, I encourage you to ask now. Nothing really off limits, finance, tax, accounting, whatever it may be, fire away. Anything?
We're looking at a cloud provider. Obviously, taking PCI compliance into effect of interesting. How did you evaluate and determine who went with?
Yeah, so great question. On a cloud provider part, so this is ever changing as softwares are ever growing, and the best part about a cloud solution is that it's always updated, right? So it's always being worked on, and there's always new releases coming out. Really, so this is a more of a personal view or a company view, but there's a difference between QuickBooks Online and Xero, and that you'll kind of get into this and maybe you wonder what you're going to go with. We tend to find one differentiator between both of them. So if you have inventory in any kind of capacity, we would at this point today, we would recommend QuickBooks Online for that. Xero doesn't tend to handle the inventory and the inventory costing and the COGS model very well. That they're working on it as they're probably recording me saying this. But that's one of the biggest things. Xero's, their slogan is beautiful accounting software. It definitely is more of the, we equate it to more of the Mac version of accounting software, and QuickBooks Online looks a little bit more Windows based. So people tend to choose just based off the looks of it. But functionality wise, they're pretty comparable besides inventory and inventory costing.
Two questions. One is PCI related, but let me start with, if you have a SaaS model and you're charging a flat monthly fee, what are our requirements for sales tax from state to state? So if it's a flat fee of $39.99 a month, what do we have for future development?
Yeah, so I'm going to go back to the answer over here. It depends. Every state has its own rules. So in the state of Texas, at least, services is something that the state can charge sales tax on. When you say a SaaS model, it really depends exactly what you're doing. So the state puts out rules as to what they can collect sales tax on from a services standpoint. So your SaaS and what you're providing could fall within or outside of those rules. Further than that, for SaaS and really a lot of the more computer focused, the state is not as up to date as you might imagine. It's a joke. The state's way behind. They still call things like data processing, people like entering information into computers, and I don't know who. I hope your job's not that. But they call that data processing, whereas a lot of what we think today is data processing is completely different, right? Like we're creating systems that are doing this for us automatically. So it's one of those things that you really need to look at and say, okay, here's the rules in Texas, or here's the rules in the state that I'm doing this business in. Where are my employees at? Where are my customers at? And really figure out whether or not it's something that's eligible for the tax. And then if it is, it's just like any other sales tax. You got to collect and you got to remit that sales tax when you send out your invoice.
And then if you're using a third party like Braintree to process your monthly, do we have to do PCI compliance? And because we're not storing anything on our back end, everything's done through Braintree. It's kind of transparent on their end. It's not transparent. It's a Chinese wall. You can't see anything. What PCI requirements do we have? One. Let's take your name on.
Yeah.
So, I think the PCI side is something that we're not as well versed in a sense, and I don't know. As you're starting out, there's varying levels of what you should be worried about, and I think that that falls in line as you continue to grow. But Mike, maybe you can answer the question just about a credit card processor and the taxation of that.
Yeah, so if you're using a third-party system especially, a lot of the liability really falls on that third-party provider. Your use of that system, I mean, you're in control of what you're choosing for your business model, so some of it is within your choice, but like in the other instance, if you built your own custom backend that was invoicing customers and collecting sales tax and storing their financial data, then I think PCI compliance is a little more relevant. But using these third-party softwares to do it, a lot of it is really going to fall on their privacy policy, their terms of service, which you're kind of independently as a user not really responsible for.
I'm going to follow that up with another question.
We're not lawyers.
Yeah, no.
We're not lawyers.
Per Mike Bryant.
But from the 1099 side, so let's say you've got a customer out there that they're going to write you a check versus a customer that wishes to pay with a credit card. How is that going to affect the 1099 situation that you've got from an accounting situation at the end of the year?
That's a softball, all right.
Yeah.
So, simplest form, if you're going to pay someone over $600 and you don't collect a W-9, just pay them with their credit card. If you pay anyone with their credit card, it's really the credit card processor's responsibility to send that person a 1099 versus if you pay them ACH, give them a check, it's your fund, your bank account, cash, then you're now responsible for issuing that person a 1099. You've already paid them that money, and it's the end of the year, and you're like, shit, I need to get this person a 1099. There's like 10% of people that you follow back up with, especially if it's like a lower wage and it was a one-time thing. It's just very hard to get their information. They're not going to give it to you. So the takeaway there would just be if you're going to pay anyone not using a credit card over $600, always get a W-9 first, then they're incentivized to give you that W-9 before you give them their check.
I'm going to reiterate that. So before you pay them, request the W-9. That should be part of your process every time if you're paying any contractor or anybody working for your business. Following up to get that W-9 after the fact is a giant waste of time, and it's a big, big challenge that you'll experience in January of every year when you have all your New Year's resolutions and you're doing all these new great things.
Who was first?
Yep.
So, say you have 1099 contractors in multiple states providing services and collecting credit cards through a third-party processor. Does it make a difference where that third-party processor is actually at, or how does the regulation apply when you're combining, 10 or more states of processing in different?
Yeah.
No,
So I'm gonna
Andrew's got the answer.
I'm gonna do this high level, and then I'll let Andrew kind of go a little bit deeper. So the thing to consider is that there's federal requirements and there's state requirements. So a 1099 is a federal IRS requirement. So it's not necessarily state specific. I'll let Andrew get into the state part of that.
Yeah, well, so I think you're asking a little bit about just like what you need to do in that situation. So from the processing standpoint or the payment that you're making, like Kurt said, if you're paying someone that you're paying over $600, the 1099 requirement's there. So forget the state boundaries. I think something that you may not be thinking about, but you should be, is if you have contractors in states and they are doing things like collecting payments or running what other types of things does those specific states require of you? And so even though you may be paying a contractor or you may be paying someone, some states do have requirements that does then cause you a requirement to be eligible for sales tax, income tax, all those things that we talked about earlier in the presentation. It's a general term that states call nexus, but it's basically, am I doing business in that state? And when it comes down to that, every single state has their own rules. So it's one of those things that you always want to make sure that you go and follow. There's good tools out there that you can use. Obviously, you can go down to the detail and research and go to the state, call the state, use tools like that. But it's one of those things that it really depends on the state, and it's a tough answer to hear because you're like, there's 50 states, and it's the reality of the situation is that every state can treat it a little bit differently.
Final question.
Uh-oh.
Does PayPal account for like credit card charging? And it's kind of two questions there, because we have a lot of developers overseas, and we just tell them, hey, just send me an invoice through PayPal.
Right. Let me take it. Yeah, so anytime you pay someone outside of the country, 1099 is not necessarily required. So you're not paying a U.S. taxpayer. If they become the state where they're like an employee, so we talked a little bit earlier about what's an employee and what's a contractor, there could be other things you need to think about. You could have a international employee, which still may limit your requirements as to what you need to do. But you might have to get certain types of forms. So there's like a W-9, there's other types of things that fill out where they're basically like, I am working internationally, I am not coming to the United States, I am not subject to any kind of US tax things. So getting those things in place and making sure you have that limits your liability for any kind of concerns down the road. But that's definitely something that you want to look at. But generally, if you have folks that you're paying internationally, they're not going to be subject to US tax. You just want to make sure you're taking the right steps there.
Wrap it up.
Cool.
Cool. We've got the signal, so we're done here. We thank all of you for coming here tonight, and cheers.
Thank you guys.